Okay, so up to this point in the class, we have only dealt with service organizations. So service organizations are ones that provide a service. They do not sell a product. So for instance, you could be a hairstylist, you could be a dentist, you could be a doctor, a psychologist, you could be a counselor, you could be a teacher, you could be a professor. Those are all services. Okay, you don't walk into the classroom and then give you a product to walk out with in your hand. Okay. Now, some service businesses also sell products. So, like Los Menanos College is a service business. We provide education, but we also sell books, right? So we have a bookstore, and that's a product. So that's different, and that's what we're going to be learning about in this chapter is selling products, or what they call merchandise. And the reason why it's different when you sell merchandise is because you have to account for what it costs you to either get that product or to get the stuff to make that product. So some companies, like for instance, let's say that you're a company that sells coffee cups. You might be a company where you buy bulks of white coffee cups, right? And then you get those coffee cups, and then you go through a process of maybe adding embellishments to them and painting them and adding sequins or whatever you add to those coffee cups, right? So your cost for those coffee cups has to be accounted for. Not only the coffee cup you bought, but the cost for all of the stuff it took you to embellish the coffee cup and make it look cool, right? Plus the labor it costs you to pay the employees to make that coffee cup look good. So the coffee cup might have cost you 50 cents, but when you put in the shipping to get the coffee cup in, and the paint to paint the coffee cup, and the glitter and all that kind of stuff, your coffee cup cost might be $5. So if you bought that coffee cup for 50 cents and you sell it for $1, you're thinking you're making 50 cents, but you're really not, because you have to account for all of what they call the cost of the goods sold. And that's going to be a new account you're going to be dealing with. The cost of the goods sold. This is where a lot of small businesses get themselves in big financial trouble. And this is why. Let's say that you have a jewelry making business and you buy all the stuff to make jewelry. Okay. So you buy the stuff and you make jewelry and you sell it out of your garage, or maybe you go to art and craft shows or things like that and you sell your jewelry, right? So in the cost, you are only accounting for the product, right? The metal you use and the gems you use and all that kind of stuff. But you also have to account for what it costs to get it shipped to you, what it costs you to get it to the customer, what you are paying, what you would pay yourself as an employee to make that product. That's part of the cost. And this is where small businesses get in trouble. They don't account for all of the actual costs. So they think it costs them $10 to make a pair of earrings. So they sell it for $18. So they're making $8 a pair of earrings, right? But they don't realize that they didn't account for their salary. So when they get big enough and they have to hire an employee to make those earrings for them, and they figure out that they have to pay the employee $7 in wages every time they make a pair of earrings, that means they've only made $1 per pair of earrings. So it's a real important part that comes into play when we look at about costing. So this chapter is all about merchandising and how we go about selling merchandise, how that differs for organizations. Okay, so in this chapter, we are going to be looking at first, we're going to look a little bit at operating cycles. We're going to talk a little bit about the cost of inventory, perpetual inventory, and periodic inventory. This is an important thing to note. In chapter 5, you will only be dealing with perpetual inventory. Okay, all of chapter 6 is periodic inventory. And you don't know the difference yet, maybe, but that's okay. All right. We're going to be looking at recording purchases. So what it looks like from the side of the buyer, and how we do freight costs as a buyer, purchase returns and allowances as a buyer, purchase discounts. So we're going to be looking at everything from the buyer's perspective. And the way you do things as a buyer in accounting and the way you do things as a seller in accounting is different. Okay. So the second part of the chapter is all about the seller, how we go about sales returns and allowances and sales discounts. And then we'll look at the income statement part about figuring out gross profit and things like that. So we'll be doing the sales part on Wednesday. So when you're done here today, you'll need to finish reading chapter 5 before Wednesday. Now, some people are like, what do you have to do everything different for if you're a buyer versus a seller? Well, you've been doing that all along, okay? If you're a seller and you sell insurance to somebody, you on account, you're going to debit accounts receivable and you're going to credit service revenue. Well, if you're a buyer, you're on the other side of that transaction. You're buying the insurance, so you're going to debit insurance expense and you're going to credit cash. So there's always been that difference, but now it's getting more detailed because we're looking at selling products. Okay. So merchandising companies are companies where when the customer walks out, they actually have something in their hand, okay? And, you know, these are like Costco and Walmart, and even McDonald's is a merchandising company because when you walk out, you have food in your hand. That is a product. That is a product that has been sold. So now in chapter 5, you're not going to have service revenue. You're going to have a new account called sales revenue. Okay, sales revenue. All right, so I'm going to show you an image here, and I want you to just look at one part of this image first. Okay, so do not look at the part in the middle that shows the blue boxes yet. Don't look at that yet. Just look at the other ones. So before, we didn't have sales revenue, we had service revenue, right? Service revenue less expenses, we didn't call it operating expenses before, right? We called it just expenses, equals your net income, right? Revenue minus expenses is net income. Well, now, when you figure out the net income for a merchandising company, you have the 2 extra steps that are in blue, okay? So the way the financial statements work is you have your sales revenue less or minus the cost of goods sold. That's what it cost you to sell those goods that created that revenue. And that equals what they call gross profit. Then from the gross profit, you subtract or less operating expenses, and then you get to your net income. So it's kind of interesting if you look at sales companies, you'll see that, you know, you might see a sales company and they're talking about, oh, our sales revenue was $6.5 million. And it's like, oh yeah, that's great, right? But you really want to know, what was their gross profit? What was their profit after the cost of selling all that merchandise? Okay. All right. So new accounts you're going to have sales revenue, cost of goods sold. And gross profit isn't actually an account. That's just a subtotal in the report. But sales revenue and cost of goods sold are both accounts. All right, so let's look at this. VE52, I think this is just a really, I don't know if we're going to do this one actually. Let me look at this one and see. This is on page 538. I don't think we're going to do this one. No, let's see. No, we're not doing this one. We're skipping that one. We're going on to the next one. Okay. All right, the other thing we want to talk a little bit about is operating cycles and just kind of the difference between service companies and merchandising companies. So an operating cycle in a service company tends to be shorter, and an operating cycle is the time from when you provide the service until the time you get paid. Or in a merchandising company, it's from the time that you buy the inventory to the time that you're paid for selling the inventory. So in a service company, you don't necessarily need cash in order to provide your service, okay? You might need some cash, like if you're, I don't know, a dentist or something, you might need stuff to do fillings and stuff like that, right? So that would be supplies. So you need some cash for that. But generally, you don't need cash. If you're a tutor, you could just start tutoring, right? So so generally what happens is it starts here with providing the service. Then you bill your customers' accounts receivable. You get the money is mailed to you and it gets cash, and then you continue to provide your service. So if you don't get paid from your customers, you can still pretty much keep going as a service provider. Now, as a merchandising company, the cash is the key aspect you have to have, because you need the cash to buy the inventory. You need the cash to buy whatever it is you're going to sell. So you get the cash, you buy the inventory, You sell the inventory, you bill your customers, you get the payment in the mail, you get more cash so that you can buy more inventory. So in a merchandising company, if you're not getting paid from your customers, you get in a very, very difficult situation because you don't have the capital or the cash to buy more merchandise. Okay. All right. Now this right here is just kind of what they call in this chapter, it's perpetual inventory. We're looking at perpetual, not periodic. Next chapter is periodic. So perpetual inventory, the numbers that play into it is we have our beginning inventory cost plus what we've purchased, the cost of goods purchased, which they call the cost of goods available for sale, or it would be the inventory on the shelf, the cost of the inventory on the shelf, or the cost of goods available for sale. From that cost of goods available for sale, you would subtract the cost of goods sold, whatever you sold, and that would tell you how much you have in the end. Okay. Now, we're not going to actually be going through that process. We're going to be going through a perpetual system that's happening. But what a perpetual system means is that, so perpetuate means to keep it going. So that means that every time you make a sale, you're updating your inventory. Every time you make a sale, you're updating your inventory and your revenue and everything. Every time you buy something as the buyer, you're updating your inventory as well. So like when you go to Walmart or you go to Macy's or you go to McDonald's, those companies use computerized systems that have perpetual inventory. So that means that if you buy a French fry at McDonald's, they actually take those fries out of inventory when you make that sale. When you make that sale, they take that out of inventory. Okay. And that creates the correct inventory. It's not always perfectly correct. Sometimes you have to do inventory counts to update it, but that's kind of how it works. Okay, so that's what we're going to be doing. Okay, so we're not going to be looking at periodic at all. We are going to look at perpetual. Okay, so this is where we maintain detailed records of the cost of each inventory item that we purchase and we sell. Each time we make a purchase and each time we make a sale, we update things. Okay. All right, so we already talked about that. Yeah, it just says some of the advantages that you pretty much know what you have in inventory when, and it's something that it helps you to keep better control of your assets. All right. So when we look at these problems in this chapter, one of the most important things is going to be asking yourself, am I the buyer? Or actually, who am I? Who am I? Because if you're the buyer or the seller, you're going to do things differently. Okay. Now, in the real world, the buyer and the seller will use invoices. So this picture of this invoice here on the slide is an invoice that has been produced by PW Audio Supply, the seller. And then if you look closer at the video, you'll see that the buyer is Sock Stereo. It gives a list of the details of what Sock Stereo bought and then the total that Sock Stereo owes. You'll also see that it shows the terms, which we're going to learn what terms mean. 2% 10, net 30 is how that's read. So we're going to learn about that. And it says FOB shipping point, which we're going to talk a little bit about that, but you don't have to do anything with that. Now, this is what you would get in the real world. PW Audio Supply, as the seller, would be producing this invoice, and Sock Stereo, as the buyer, would be getting this invoice in the mail to pay the bill. Now, you are not going to be using these, though. This is what you would call a source document that creates the entry you do in your system. Everything you get is going to be in a paragraph. Okay, so you're going to get all the information you need in a paragraph. All right, so recording the purchase of inventory. And I just noticed this is cut off on here. Is this cut off? Oh, there we go. Recording the purchase of inventory. So we're going to look over here at the description here, and it says Sock Stereo, the buyer, uses as a purchase invoice the sales invoice prepared by PW Audio Supply, the seller. Prepare the journal entry for Sock Stereo for the invoice from PW Audio Supply. Okay, so who are we? We are Sox Stereo. Who is Sox Stereo? They are the buyer. They're the buyer, okay? The buyer. So as the buyer, what did I get? Well, I got inventory. I got inventory. This is stuff that I'm going to be selling later. I got inventory. Inventory is what kind of an account? It is an asset. Assets have what kind of accounts? They have debit balances. So how are we going to make it go up? We are going to debit it. So we are going to debit inventory, $3,800, May 4th. Okay. What's the other part of the transaction? How do we know it's accounts payable? Well, either it's going to tell you that you bought it on account. That means it's an accounts payable. Or whenever you see terms, if you're the buyer or the seller and it says terms, that means it was either bought or sold on account, which means accounts payable. So the terms tell you how the bill has to be paid. So what these terms here mean is that if you pay this bill in 10 days, you get to take a 2% discount. But if you pay it on the due date in 30 days, then it's just net 30. You just pay the full invoice in 30 days.
So you said if you see the word term, it's, what is it again?
This is an example of an entry for a purchase as the buyer, okay? Now, this information here is just for your information. We're not going to be doing any problems with this, but what this has to do with is when you're doing inventory costing, it has to do with who owns the inventory. And it depends on if the inventory is FOB shipping point or FOB destination. It also has to do with who pays for the freight. So if it's FOB shipping point, then the buyer pays for the freight, okay? And here's a note that you need to make. If the buyer pays for the freight, the cost of freight goes to inventory. So when you're the buyer, here's the note you want to make. When you're the buyer, everything goes to inventory. Just make a note of that. When you're the buyer, everything goes to inventory. And you'll see what I mean when we kind of get through some of the things here, okay? So when it's FOB shipping point, the buyer takes ownership of the item as soon as it's put on the truck. So that means if it takes 3 months to get here and you bought it, you own it the minute it goes on that truck. So if it's not in your warehouse and you're doing an inventory count, you still have to count what's on that truck because you legally own it, okay? If it's FOB destination, that means the seller is paying the freight. And as the seller, it actually doesn't, everything does not go to inventory as a seller. We'll talk more about that when we talk about the sales piece, but there's actually an account called freight expense or freight out. But ownership passes to the buyer once it gets to the buyer. So that means that the whole time it's on the truck, the seller owns it if it's FOB destination, okay? Yeah, we're not going to be dealing with any of this, but this is just like information for you to know because it would be important for you to know. All right. Okay, so we're going to look at 2 more entries here, okay? So assume upon delivery of goods on May 6th, Sox Stereo pays Public Freight Company $150 for freight charges. The entry on Sox Stereo's books is, so who are we? We're Sox Stereo. Who's Sox Stereo? They are the buyer. They're the buyer, okay? The buyer. And when you're the buyer, everything goes to inventory. So that means that the freight charges, you're going to debit on May 6th, you're going to debit inventory $150. And why does it go to inventory? Because the cost of getting that inventory there was $150. So part of the cost of your inventory are the freight charges. That's part of your cost. You could buy a coffee cup for 50 cents and have it shipped from the other side of the world, and it could cost you $50 to have it shipped to you. So the cost of that coffee cup is no longer 50 cents. It's $50.50, okay? The other part of this is you credit cash $150 because it says that we paid for it, okay? We pays, remember pays or paid means cash, and we're paying, so our cash is going down. So we're going to credit cash $150, all right? Now they're just showing here what would happen if you're the seller. I don't know why they have that on this screen because it says freight cost by the buyer, but let's assume the freight on the invoice was PW Audio Supply, the seller was going to pay for it. If the seller was going to pay, you would debit freight out or delivery expense and you would credit cash. Don't worry about that right now. We're going to look at the seller later. Okay. All right. Now, the other thing that we can have when we are buying goods are purchase returns and purchase allowances. So purchase returns is that, let's say that I buy a pen from Office Depot and it's a purple pen and I buy it and I get it back to the office and I start using it and I'm like, oh my gosh, this is a horrible color purple. I take it back to Office Depot and I say, hey, this is a horrible color purple pen. I don't want it. And they say, okay, well, I paid $5 for it. I give them the pen, they give me $5 back. That would be a purchase return, okay? And the allowance is that I buy a purple pen for $5 from Office Depot. I get home, I use the pen. I'm like, oh my God, this is an ugly color pen. I go back to Office Depot and I say, hey, this is an ugly color purple. I don't want it. I want to return it. And Office Depot doesn't want that pen back. What are they going to do with it? It's a used pen, right? So they're going to try and get me to keep that pen. And the way they do it is by giving me what they call an allowance. So they might say to me, well, you know what? If you keep that pen, you paid $5. We'll give you a dollar off. And I'm like, heck no, I hate the color purple. I'm not keeping the pen if you give me $1 off. And they're like, okay, well, I'll tell you what, we'll give you 50% off. So we'll give you $2.50 off that pen if you just keep the pen. And I'm like, okay, I guess so. I can write on cardboard boxes with it. So they give me a $2.50 allowance. All right. So they have now reduced the cost of my pen by $2.50. So the $2.50 allowance would also go to inventory. So as the buyer, everything goes to inventory. So if there's a return or an allowance, it goes to inventory. And we're going to look at samples of this, so don't freak out yet. We're going to do some problems with this. Okay. You just have to know that as the buyer, freight, returns, and allowances all go to inventory as the buyer. It's different for the seller, but as the buyer. Okay, so here's one example. Assume stock stereo, the buyer, returned goods costing $300 to PW Audio Supply on May 8th. So what are they getting? Well, they're getting a couple of things. One, they're getting a lower inventory because they're actually returning it, or they're getting a lower cost of their inventory if it's an allowance. So in order to reduce the cost of the inventory by either a return or allowance, inventory is an asset. Assets have a debit balance. So you're going to do the opposite. You're going to credit inventory. What else they're getting is they're getting a lower bill, okay? So they're not going to owe that $300 to PW Audio Supply anymore. So accounts payable is a liability. Liabilities have a credit balance. So in order to make their credit balance liability go down, they have to do the opposite. They have to debit it. So they're going to debit accounts payable $300, and they're going to credit inventory $300. Okay. And again, we're going to do some sample problems with this. All right. Now, purchase discounts. So this is what they call credit terms. And this is where we see the different types of terms that an invoice could have. And the way, when you're a buyer, the reason why you might want to take advantage of terms is that if you pay earlier, you get a discount. So that means you have to pay less money. So you can use more of your cash to buy more goods. Okay. So for the seller too, they offer terms to get a little bit less money so that they get their money quicker and they can buy more stuff to sell to people. Okay. So example of credit terms. So down here on the bottom, I have 2/10, N30. And how that is read is 2% 10, net 30. So this means that if they pay the bill within 10 days, they get a 2% discount. But if they don't, and they go longer than 10 days, then they have to pay the net amount of the invoice, whatever the total is, within 30 days. If they don't pay within 30 days, then they're going to get late charges and stuff, but we don't get into that in this class. Okay. All right, so let's look at this. Now, this is just showing you as an example. Don't worry about these two here. In all the years I worked in accounting, I never saw 1% 10 end of month or net 10 end of month. And that's just saying that they get a 1% discount if they pay it within the first 10 days of the next month for the first one. And the next one says that the net amount is due within the first 10 days of the next month. Don't worry about that. You're going to see more of them that are like this 2% 10 net 30, but it might be 3% 15 net 30 or 2% 20 net 30 or 10%. It's not going to be 10%, 1% 10 net 30. So the numbers are going to change, but it still means the same thing. Okay. The first number is the percentage of discount. The second number is the number of days that you have to pay it within to get that discount. And then the last is how long you have to pay the discount in full, like if you don't pay it within the discount terms. Okay. All right, so here is an example, and you are going to need to write this down. So let's read the problem first. Don't panic yet. There's a whole method here on how you figure this out. So assume that Sox Stereo, remember they're the buyer, pays the balance due of $3,500, gross invoice price of $3,800 less purchase and returns allowances of $300 on May 14th, the last day of the discount period. Prepare the journal entry Sox Stereo makes on May 14th to record the payment. Don't look at the entry yet. Look at the description, okay? So the formula for this goes like this. It's your purchase amount minus any returns or allowances is going to give you your accounts payable number. So in this case, the purchase amount was $3,800 minus the return of $300 gives us $3,500, right? Okay. Then to figure out our discount, what we do is we take the accounts payable number that we just figured out, okay, $3,500 times the discount percentage. So it told us in this problem that the discount percentage was 2%. So this would be $3,500 times 2%, and that's going to give you your discount dollar amount. And in this case, it's $70. $3,500 times 2% is $70. Then you take your accounts payable dollar amount minus the discount dollar amount. That's going to tell you how much you're actually going to pay, your cash amount. So you have to do all of that first to get your numbers before you can do the entry. So let's look at the very bottom of the screen if you can see that. It shows $3,800 was the purchase amount, right? Minus the returns or allowances of $300. That gave us an accounts payable number of $3,500. We take that $3,500 and we multiply it by 2%, and that gives us our discount dollar amount, right? We then take the accounts payable number of $3,500 minus the $70, and that gives us our cash amount of $3,430. Okay, now we have what we need to do the entry. So first of all, pays or paid tells us we're going to be crediting cash, right? Pays or paid says we're crediting cash. How much are we going to credit cash? Well, $3,430. We just figured it out, okay? We're reducing the amount that we owe. Accounts payable is a liability. So we are going to be debiting it to make it go down. How much are we debiting accounts payable? Well, we figured it out. It's $3,500, okay? It's the purchases minus returns or allowances. So accounts payable is $3,500. We're going to debit at $3,500. What do we do with the discount dollar amount? It goes to inventory when you're the buyer. So we're going to debit accounts payable, $3,500. We're going to credit inventory, $70. And we're going to credit cash, $3,430. Okay. So that is an example of how you figure out all the numbers you need when you make a payment using the discount. I just want to look at something real quick. Okay. And we'll come
go back
again. Yeah, we'll come back to this again. I just want to show you something real quick. So if you didn't take the discount, like if you went longer than 10 days to pay the bill, what would happen is you would just be paying the accounts payable amount. So it would be purchases minus returns and allowances. So you would debit accounts payable 3,500 and you would credit cash 3,500. But that's if you don't take the discount. If you go longer than 10 days, then you cannot take the discount. You have to pay the full amount, which is the purchases minus returns and allowances. Okay, but this is the example of the one when you're taking a discount.